This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was so great to have Dr. Lacey Hunt back on the show. You know, there's so much fear-mongering about Project Zimbabwe out on the markets. And really what it comes down to is that in order for us to see that kind of massive hyperinflation driven by monetary policy, there actually has to be a change in the Federal Reserve Act. It simply isn't enough the way it is written. And like Dr. Lacey Hunt was saying, it's not out of the realm of impossibility that they rewrite the act. But the thing is anyone who's assuming that this is imminent is probably holding their breath unnecessarily. What's your take on all of that? What did you take away from the interview?
Well, what I'm really trying to do, Patrick, in the last few weeks is to ask all of our top macro and particularly the fixed income guys, how does this whole story play out? We've got a very strong deflationary macro backdrop, but we've also got policy actions that a lot of people think are eventually inflationary. What's the roadmap look like? How do we get from here to there? So we heard David Rosenberg last week saying he thinks that stagflation is where you get to, but not for 3 years, and it's deflationary until then. We had Dr. Pippa Malmgren on All Stars tell us she thinks inflation is coming much sooner than a lot of these other guests think. So I'm just trying to assimilate a lot of different worldviews and kind of plug them all together and make sense of them. And I think Dr. Lacey Hunt basically said, look, his view, and I disagree with him slightly, is it has to stay deflationary because given the Federal Reserve Act, it really can't be anything else. Now, the reason I disagree is, look, they've pretty much ignored the law when it came to the junk bond market. They say they're willing to bail out junk bonds even by using some kind of special purpose vehicle to pretend that junk bonds are somehow agency bonds. It seems that the government is very willing to work around the intention of its own laws. So it feels to me like the political environment is very ready to bend the rules, so I don't really worry too much about what the Federal Reserve Act says. But I do agree with him that it's got to be deflationary for a while until you really get to the point where you're not just talking about it, you're not just doing stimulus to buy bonds, but you're actually using the Fed's ability. And, what he said is you'd have to change the rules so the Fed is allowed to spend money rather than just buy assets. I would say you have to get to the point where we're actually bending the rules enough to go ahead and do that. And, they can play all kinds of games. You just do a lot of government spending, you issue new bonds, you let private holders hold them for a couple of weeks before the Fed buys them, and you've worked around the intention of the Federal Reserve Act, and you're supposedly not monetizing government spending, although effectively that's really what you're doing. So I think it's a question of when we actually see implementation of spending programs that pump money into the real economy that we need to watch and see what happens in terms of price inflation and wage inflation and so forth. I think stagflation is definitely the highest candidate for what we eventually get to. I just wonder about the path of how we get there. So I'm just trying to assimilate a worldview out of the feedback that we get from all of our guests. And I thought Dr. Hunt kind of rounded out the picture with some of the other people that we've talked to. I'll look for asking some of the same questions of other guests in coming weeks. But what I want to do for the rest of today's postgame, Patrick, is dive into the postgame chart book that you prepared, and let's have a longer conversation than we had time for in the market wrap about this bear market rally. At least that's what you and I think it is. But there's a lot of people who are saying, no, it's over, baby. We've passed peak infections. We're reopening the economy. This thing is ending. The market is anticipating a move back to all-time highs because the bad news, the worst of it, is behind us. Let's examine both sides of this argument. Listeners, you'll find the download link for the chart book that is going to facilitate this conversation in your Research Roundup email. If you don't have a Research Roundup email, it means you're not registered yet at MacroVoices.com. Just go to our homepage, MacroVoices.com, look for the red button that says Looking for the Downloads. Patrick, let's go ahead and dive in on page 2 here. You're showing kind of an analog of the S&P 500 to what typical bear markets look like. Give us the story here.
Well, actually, this isn't a typical one. I specifically overlaid what happened in 2008 and particularly deeper into the bear market when the Lehman event occurred, and then how the rest of the market played out afterwards. And so far, the market is overshooting what certainly played out in 2008. And what I just wanted to do was take a moment to just go and actually then look back and let's analyze some of the past major bear markets and look at what bear market rallies look like in them. And I thought that would be a great journey to go on. And so what I did was I snagged a chart on page 3 of the 1929 bear market. The initial drop in 1929 saw close to a 50% wipeout in a span of 2 months, including a 3-week period that saw a very similar drop the way we had, about 30 to 35% in like 2-3 weeks. It was just a nasty and very ugly drop that happened in that October period. But then, after hitting a short-term low into the first quarter of 1930, we saw a 5-month bear market rally. Now, this one did muster up a 50% retrace. Our current bear market rally, I'm still convinced it is. It has only been is only like 1 or 2 months into that bounce, and it's already surpassed more than 50 and 61% on the short term. But back then, anyway, it was a 5-month prolonged period where the market just crawled higher and higher and higher, going until it reached about 50% of retracement. Even though it took 5 months to really play out, it didn't change the inevitable, which is that the market then turned around and began selling. And so I wanted to move on and go to page 4, where we've had Ray Dalio and others try to compare this far more to like a 1937 period than a 1929 period. And so I wanted to see how that one played out. And that was, less than a decade later from the 1929 crash. And we can again see a period where the S&P 500 wiped out about 50% of its value in just months in a very rapid crash. But subsequently, after in the early part of 1938, when it established a short-term low, we saw a meaningful rally. It was about a 61.8% retracement, but a meaningful rally. It was like 50, 60% off of the lows. But again, it lasted something like 200 some odd days. I mean, it was again a 6-7 month bear market rally that rebounded. But yet, over several years afterwards, even though it was a lot of sideways price action, it did inevitably make lower lows in what is the typical fashion of a bear market, which is that it's not a screaming rally higher. It just rallies back towards the highs and fades again and over again in that kind of a distribution cycle. The last one I wanted to touch on, which was a slightly different one, was the 1974 bear market drop. And in 1974, the part that makes this a slightly different is that the initial drop from 1973 to the middle of 1973 was very mild. We only saw like a 20% drop in the markets. And so the bear market rally that ensued on the other side simply didn't have that much to retrace from, because the big sell-off didn't really kick in. And then, but it was once that bear market rally was over, that one took about 2 to 3 months of rallying, and then it resumed. And so the most important takeaway, I think, that I want to suggest there, Eric, is like these bear market rallies, they can take 2 to 5 months, 2 to 6 months. There's nothing saying that this has to be over 1 or 2 months after the bounce and that we should somehow already be dumping to the downside in the next wave. These things can drag on. Like, what if this bear market rally lasts until June, July, and just kind of keeps crawling and muddling along here? And it's just everyone that's waiting for it to crash is burning theta as their put options are decaying. And then you turn around and you have all the bulls trying to go long, but the market can't get any traction to the upside. I really think it's going to play out a little differently than everyone is expecting, because everyone thinks it's all going to happen right away, right?
Well, I see this a little differently. It seems to me like you're looking for analogs to past events, past bear markets, and certainly that's a useful exercise to understand a range of possibilities. I think we're in completely unprecedented times, though. There's never been a time in history when we had this kind of monetary policy intervention participation in equity markets. So the way that I look at this is, if we're going to have normal market forces play out, clearly this should be a bear market rally. We hit the 61.8% Fibonacci retrace, which is a key level for bear market retracements. You know, that's kind of the number where the bear market rally ought to be done by there. And furthermore, Patrick, we hit it on the day of a Fed announcement, which oftentimes you get a blow off, and that's kind of like the turning point in the market, the sell the news event, so to speak. And we got above 29.30, which was that key Fibonacci level. We traded there during the day, but we closed below it. So you never had a closing print above the 61.8% Fibonacci, which if there had been a closing print there, it would have been a signal that maybe there's further to go. But you did have a chance to sell it all the way up at 29.60 something. So it so far feels like it's following all of the right recipe to be a bear market rally, and now we go down to new lows over the next several months. We get down to a number lower than 2174, which was the low print so far on S&P futures. The thing is, Patrick, you know, I think I've made some pretty good arguments fundamentally over the years on MacroVoices when I've said, look, I think this market is way overvalued. I think it should go down, but I don't think it's going to go down because we've got so much intervention from the government. I think they're going to fuel the rally continuing. And that's proven right. As much as I think I did make good bearish arguments on the fundamentals, the market kept on going higher. And I think we have a very, very bearish set of fundamentals right now. But I just don't know whether or not, you know, Fed money printing power is going to outweigh market fundamentals. It's really hard for me to decide. And the reason that I decided not to short this, even though I do think the most probable answer is this is the top of a bear market rally, is because it's so hard to say whether or not the Fed is going to print money to rescue the stock market. They can't print storage tanks to rescue the super contango in the oil market, although today we had a big counter-trend rally in those time spreads. So, you know, I just look at other markets as being a safer way to express this. But I think that's the question, really, is will this unprecedented era of monetary stimulus intervention overwhelm the fundamentals? And it seems like it's hard because the fundamentals are pretty darn bearish, but you never know.
Right. And so what I wanted to do on page 6, for instance, you were saying that Pippa was suggesting that inflation would come a lot sooner, even though Dr. Lacey Hunt and David Rosenberg think that deflationary pressures are still the dominant force on the short term. But what I wanted to just kind of reflect upon is what are periods where inflation or massive monetary stimulus or asset purchases, how did stock markets behave that way? Because there's a lot of people that just assume it's a given that if the Fed prints a whole bunch of money and buys assets, that somehow that in itself is almost a certain guarantee that the stock market's going higher. And while it is definitely possible, and I don't want to say that it's not, when you think back and look at different scenarios, like on page 6, I have the period from 1965 through 1981, where inflation ran very hot in the U.S. The U.S. was just coming off the gold standard, so just entering a period where money was decoupled from gold. Inflation was running pretty hot, and yet the Dow Jones for pretty much 15 plus years could not make a higher high throughout that entire period. But more importantly, on a real purchasing power basis, you saw almost a 90% wipeout of the value of the Dow Jones on a real basis. And it was a very ugly time. Skipping ahead very quickly to page 9, I just want to stay on this theme. I wanted to jump to Japanese Nikkei. A lot of people then reference the fact, well, look, when Shinzo Abe started Abenomics back in 2013, the Japanese Nikkei went roaring higher, did over 100% advance in a couple of years, just with this huge, massive advance. And there's no denying that was, in fact, what the Nikkei did. But there was an interesting circumstance there because no other central bank in the world at that time has actively adopted such a currency destructive monetary policy like Japan did at the time. And when you go to page 10, you can see that while the Nikkei had that huge rally from 2013 through 2015-16 into 2015, you also, though, it came on the back of the US dollar rallying materially against the yen. I mean, we saw the yen lose 40% of its value. And so one of the huge precipitating drivers, the tailwinds behind the Nikkei, was a huge devaluation of their currency. And while the rest of the world had very stable currency structure, the Japanese yen was devalued very aggressively. And that contributed massively to that increase. And so I asked the question, and maybe you can give me your opinion on that. I mean, I sort of am thinking that, well, yeah, maybe that scenario can happen where the Fed just starts printing a lot of money and buying up tons of assets. But if the US dollar is not materially in a bear market and being driven much lower relative to others, I mean, without that tailwind, I mean, can it do it alone on that? I personally think we would need a U.S. dollar bear market really well underway for equities to be inflating higher. What's your take on that?
I don't know, Patrick. It seems to me that we've got unprecedented amounts of both fiscal and monetary stimulus, and the conversation is shifting. The political and policy narrative is shifting from what used to be entirely an asset purchase kind of discussion, which would, if they were going to do more of the old style of QE, and that's all they were going to do, that would be, I think, very much supportive of higher stock prices. But it seems like now the narrative is shifting to much more of a broader-based MMT, support the Main Street economy as opposed to just the financial economy. So I think that there's a lot of moving parts here, and I really don't have any firm predictions. That's the reason I've preferred to trade the oil market instead of the stock market, is I know they can't print storage tanks, but they can print more money, and they can get that money into the hands either of the people, hardworking people that need it, or into the hands of bankers that buy stocks with it. It remains to be seen how this plays out from here.
Right. So what I also wanted to, though, touch on is a lot of people are worked up by this idea that the Fed is saying that they're going to buy junk bonds and all of these other assets in order to continue to support the market and provide the stability that was really needed during that crisis. But the interesting part is that there are two central banks in the world that did very large asset purchases over the last decade, Japan and Europe. And what I have is, well, we already showed that Japan chart, but when we look at that Euro Stock 50, and it kind of asks the question, I mean, if a very large asset purchases by their respective central banks was that bullish, why have we not seen very bullish charts? I'm sure a lot of our listeners are thinking, is because a lot of it's been routed from Europe to other places in the world to be invested elsewhere, like in the U.S. markets or something like that. And it does make sense. But I mean, I just don't know whether it's easy to just make the assumption that just because these asset purchases are being made and this capital is being actually made available for reinvestment, there still has to be a risk taker that has to reallocate that liquidity back into risk assets. I mean, is that a certainty? I don't think so.
Well, I think you hit the nail on the head a minute ago, Patrick. I think that as the ECB was going through all of their stimulus that weakened the euro, a lot of people saw the double opportunity to both diversify out of their own market, get into a stronger currency. So by investing in U.S. stocks, you're in a dollar-denominated asset, which means you get the pickup on the foreign exchange benefit of the dollar appreciating, plus the stronger U.S. stock market. And I think those foreign capital flows are a big part of the reason that the S&P chart looks so much different from the Euro Stoxx 50 chart that you have here on page 11. So I do think that has played a really big role in it. What are we going to see going forward? Is it going to be a competition between the central banks as to who can print more money, and what are they going to do with it, and how is the policy going to evolve? I think it's a moving target, and I think we're in uncharted territory.
But even just to continue that, like what if the monetary policy that the Fed is implementing ultimately does become U.S. dollar bearish? I know we've had Luke Roman and all these others that are on there that are suggesting that inevitably that may happen. What if that reverses the money flow? What if the money flow is not coming into U.S. equity because the currency tailwind is now a headwind? It's really one of those really interesting puzzle pieces that we have the privilege on MacroVoices to, for the next year or two, to actually be trying to put that puzzle together as we get the new information coming in. Nonetheless, I wanted to go and just quickly end this chart book and just looking at both page 7 and 8. The 7 shows the bear market rally that's showing on the Dow Jones Industrial versus that of the S&P, which we typically show. But what I wanted to really touch on page 8 was the fact that now, where is this bear market rally been driven from? And what this chart shows is that the market cap of the 5 largest companies in the S&P 500, so only 5 of 500 companies, so 495 companies excluded, now these 5 companies make up 20% of the market cap of the S&P. And obviously the rallies in the Apples, Googles, Amazons, the Microsofts, these stocks have truly been the ones that allowed this bear market rally to be as meaningful as it has. Because if you leave those 5 companies, I mean, you can add the recent advance in Tesla and Netflix to the mix. So let's say you say outside of those kind of 7 companies, you really have not seen any meaningful rallies in most of them. And so if you're just looking at the S&P 500 on the surface, you're not getting a good pulse on what is really happening under the hood. You're just looking at the surface. And while certainly these 5 companies have been just ripping to the upside, I mean, does that mean that it's not a bear market just because Amazon is benefiting from all of this and doing this huge rally? I don't know. To me, there's more to this than just looking at the price of the S&P, and I'm still convinced it's a bear market rally. So that's where I'm standing anyway.
Well, I'm convinced it's a bear market rally too. The question is just whether the Fed can overcome gravity and cause the what should happen next not to happen. And I do feel like we're in unprecedented times. And listeners should be sure to check page 12 if you want to grab a free trial of Patrick's service, Big Picture Trading. You can get a dose of Patrick's perspective almost every single day, not just once a week on MacroVoices.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.